This video will help you understand the ins and outs of permanent life insurance so you can make a more informed decision as to which coverage is right for you. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In my last video, we touched on the basics of term life insurance, some of the features and benefits and general policy designs. In this video, I thought we'd focus on permanent life insurance. As a quick refresher, after spending close to a decade at Northwestern Mutual, I have this psychological duty to impart what I learned from my time there with the general public relative to life insurance. You can make it as complicated or as simple as you'd like it to be, but let's say for whatever reason you've decided that buying life insurance is in your best interest. By definition of buying life insurance, you'll be faced with all the myriads of different policies and structures you can buy. In my last video, I touched on how life insurance can broadly be bifurcated into term life insurance and permanent life insurance. So today we'll touch on permanent life insurance. We're going to avoid any company-specific permanent life insurance policies. Number one, they're always changing, but then number two, I want to keep this video general and so that you can use it to apply to the specifics once you're faced with them. We'll touch on common policy structures, and then we'll touch on some of the common features and benefits you find within permanent life insurance policies. And at the very end, we'll talk about who would be a good candidate for permanent life insurance and then how to strategically implement permanent life insurance. As opposed to term insurance, which is meant to expire before you do, permanent life insurance is meant to be there until the day that you die. So there's fundamentally a mindset shift you have to make when thinking about buying insurance. You're no longer insuring against something that may happen. You're insuring something that is actually going to happen. So there's a change in psychology we have to make when buying these types of policies. The life insurance benefit that's inside these programs may or may not be increasing or decreasing. That comes down to policy specifics. You might hear things like benefit option A or B relative to the life insurance death benefit. There are some IRS guidelines you have to play within, whereby life insurance death benefits may need to increase. Otherwise, the policy becomes a modified endowment contract. We'll touch on more of that another time, but specifically with permanent life insurance policies, just know the death benefit could stay the same, increase or decrease, depends on the policy. Oftentimes, but not always, there will be some level of cash value component to these permanent policies, and that functionally serves as your equity in this permanent life insurance plan. You could analogize that as your living benefit with this life insurance policy, aka stuff you can use from this policy while you're still alive. You can access that cash value in a couple of different ways. The most common two ways I see are number one, taking a straight withdrawal from the cash value. And that's where you just have the insurance company stroke you a check for a certain amount of money that's inside that cash value. The cool thing about that is you withdraw that money tax-free first or cost basis first, which means that you don't owe any taxes upon receiving cash value up to the basis in the policy. After that, the gain is considered ordinary income. The other way to get money out of this policy is a loan. So many of these insurance carriers will have a loan provision whereby you can borrow money from the cash value in this account. You'll owe an interest rate back to the policy, similar to a 401k loan. And then once you pay back the policy, then you no longer have a payment owed on the loan. You'd still have a premium payment most likely, but that policy then would just continue to accrue cash value. The unborrowed portion of the cash value still continues to receive dividends and benefits from the insurance carrier, so you're not totally SOL once you do decide to borrow some money from the plan. There's also a third way that comes to mind, which is posting your life insurance policy as collateral to get a loan from a bank or credit union. There are specific companies out there that are designed to provide you with a loan on your insurance benefit, and generally those are at much more favorable rates than what the insurance company is offering. Many of these permanent life insurance policies will kick off a dividend of some kind, and that dividend you can use to do a number of different things inside the policy. The most common things I see are obviously number one, just take the distribution as straight cash in your pocket. That's one thing you can do with any dividend. Number two, you can use that dividend to reinvest back into your policy, if you will, and purchase more life insurance. So that's one way you can have your life insurance benefit go up over time, is you use the dividend to buy a smaller life insurance policy on top of that every year. And the third most common usage I see for the dividend is to reduce your annual premium for this policy, whereby whatever your annual premium is, you just take away a little bit from whatever the dividend is. The most common permanent life insurance policy types I see out there in the marketplace: whole life insurance, universal life insurance, variable life insurance, variable universal life insurance, guaranteed universal life insurance, indexed universal life insurance, and then second to die life insurance policies. Now, you're not necessarily on the hook to make an annual payment into each one of these every single year to keep them alive. Some policies have some cool benefits where you're only on the hook to make payments over 20 years. Then when you stop, the policy is good to go forever. We'll jump into the specifics of these in other videos. We don't have time to do that today, but just know that there are some options if you don't want to be on the hook to make an annual payment every single year. The quick and dirty on that though is just like buying a piece of property. For a given amount of life insurance, the faster you want to be done making payments, the more you'll have to pay in that short time horizon. So rather than amortizing a $1 million life insurance policy over 30 years, if you want to amortize it over 10, that's fine, but you're probably going to need to make sizable payments over those first 10 years. There's pros and cons to each one of these types of policies. Some have tremendous flexibility, some have very little flexibility, some have more guarantees in them than others, some have the consumer take on more of the risk of the policy surviving all the way, and some delegate all that risk to the insurance company. There's pros and cons. We'll have to jump into these at another time, but just know that these are not all created equal. Some common features and benefits, also known as riders in the insurance space, that you'll see on some of these permanent insurance policies. The first one that comes to mind is going to be the waiver of premium, and that's in the event you become disabled. The insurance company will actually pick up the tab and pay the annual payment on your insurance policy until you're no longer disabled. Another benefit you'll find you can purchase is an additional purchase benefit or event-based purchase benefit. And that's when you reach certain milestones of age or policy year or event like getting married or having kids, where you're allowed to increase the life insurance benefit on your policy without going through any sort of health screening or underwriting. This would be attractive if in the event you know in the future you're going to want more insurance, just not today. You might want to implement this additional feature, which comes at a cost, but it's not nearly the cost of just buying all the insurance you could want in the future right now. Of course, in the future, if you wanted to increase benefits and you didn't have the additional purchase benefit, you'll have to undergo underwriting at that point, health screening, all that kind of stuff. And you can either layer on top of the existing insurance policy or buy a totally separate insurance policy. Most insurance carriers will let you decrease the amount of coverage you have at any time, which subsequently will decrease the amount that you have to pay them every year to keep the policy alive. And so that can be helpful if for now you know you need a lot of insurance and you want to accumulate some cash value relatively quickly. But in the future, maybe you decrease the amount of coverage you have. Another common feature out there is reconsideration, and that's in the event you got a less than stellar health class rating when you first applied for this permanent policy. Let's say your health has improved or you kicked the habit of smoking cigarettes, and now you want to reapply for life insurance because you think you'll get a better rate. A lot of insurance companies will let you reconsider your previous health class rating today. It doesn't mean they're going to give you back all the money you paid them extra. It just means moving forward, your policy will be at a cheaper rate than it was before. Now, not every insurance company does this, so you'll need to check with them before you actually sign on the dotted line. Like any insurance policy, there's also exclusions. Some policy exclusions would be like, for the sake of the YouTube algorithm, not aliving yourself anymore. Some policies have a 2-year exclusion on if you decide to not alive yourself. You probably wouldn't collect any sort of benefits. There's other policy exclusions such as war clauses. In the event you go deployed or you die in a war zone, you would not get life insurance benefits. Not every policy does this, so you'll need to read the fine print on that. On the topic of war, some veteran clients might be in the audience, and for those folks, we'll touch on VGLI just for a quick second. VGLI, I would consider a permanent life insurance type of policy. It just doesn't accumulate any sort of cash value. And the reason I consider it a permanent policy as opposed to term policy is because a term policy is meant to expire before you do, and VGLI allows you to make a payment for as long as you want to, and you'd get life insurance coverage in the day that you die. You could be 85 years old and still get life insurance through VGLI. Once again, there's no cash value accumulating, so whether VGLI is in your best interest or not, I'd obviously speak with a professional to make that deliberation. Really popular additional benefit with permanent life insurance policies, especially in 2021 here in Washington State, was the ability to add long-term care benefits to the death benefit, whereby the death benefit doubles as a long-term care benefit pool and a life insurance policy. So if you die, your family gets a bunch of life insurance. If you need long-term care, you can prematurely draw down on that life insurance to use those monies for long-term care. And then whatever's left over when you die, that would be considered death benefit, tax-free to your heirs. The reason this was so popular was because back in 2021, you had to buy a long-term care policy because by the end of 2021, you had to have a long-term care insurance policy on your books to qualify for an exemption from walk cares. Another feature you can do with some of these policies is as they grow, you're allowed to split them. And I'm not going to get into the nuances as to why you would ever split a life insurance policy, but let's just say you have one policy and you want to split it and make changes to each one independently. You're allowed to do that. You're allowed to split policies. Again, check with the insurance carrier. 2 last features and benefits on permanent life insurance. The biggest one for retirees is the ability to annuitize the cash value inside their life insurance plan. So let's say you're getting on in years and you decide, hey, based on my investment accounts, I'm not super comfortable with the way that the market's moving and I don't know if I want to pull money out of my investment accounts right now. Oftentimes with these cash values, which are not tied to the market if you don't go with like an indexed or variable life insurance policy, you're allowed to annuitize the cash value to create a guaranteed income stream that you can't outlive. And that's nice, as opposed to taking your investment account, which might be depressed here in 2022, try to buy an annuity from an insurance company at those rates. You might have more favorable rates if you just choose to convert the cash value in your life insurance plan into an annuity that you can't outlive. The last thing I would say is that generally group permanent life insurance plans can come at a reduced cost compared to buying permanent life insurance on the private market. In particular, back in 2021, there's a huge push through a company called Trustmark that a lot of employers were funneling their clients into to structure those kind of life insurance long-term care hybrid policies. But essentially the rate and the smallness of the benefit they were willing to offer, you couldn't really go replicate in the private market. So depending on what your company offers, you could get permanent life insurance at a reduced rate compared to buying it in the private market. So who's a good candidate for things like permanent life insurance? If you're somebody with large means, you have an easier time thinking long-term about making some investments. So estate planning is great for adding liquidity to the estate when you do pass away, if everything else is illiquid. There's also things like irrevocable life insurance trusts that we'll have to touch on another time, but there's basically some cool planning you can do in the estate planning space with permanent life insurance policies. Some other client profiles that might be a good candidate are folks that are looking for permanent life insurance and long-term care insurance, but it wouldn't make sense to separate those two into different policies. You can combine long-term care and life insurance together inside these permanent plans or hybrid plans. That could be somebody who's a good candidate for X-raying these plans. A very common use of permanent life insurance will be through funding a buy-sell agreement. Let's say you're trying to buy out the ownership of somebody else, but when they pass away, you might not have the cash flow to do it. If you had a life insurance policy on that person, when they die and a life insurance check goes to you, you can use that check to buy out the surviving spouse or the estate for their ownership of the business. Another cool feature of permanent life insurance is to use it on key person insurance. This ties into a conversation on split dollar, which we don't have a chance to dive into that specifically today, but just know that split dollar arrangements do involve using a permanent life insurance policy to provide coverage on a key person, as well as having that cash value accumulate. It's a little complicated, so we're not going to dive into it in today's video, but if you'd like one, just let me know and I can put one together. Another common use of permanent life insurance is through non-qualified deferred compensation plan funding. So non-qualified deferred compensation plans, those are not allowed to have all of that money pooled in some sort of trust protected from creditors. However, if you own the cash value inside of a permanent life insurance plan, it's kind of hard for creditors to get access to permanent life insurance plans. And if the permanent life insurance cash value grows fast enough, that might be a great funding tool to pay the employees who have invested into the non-qualified deferred compensation plan. It's a great way to make sure that you have the money retained to pay out this money. Another hot topic as your wealth continues to grow you might run into are things like premium financing. And that's essentially where you use a loan from a bank to buy a permanent life insurance plan. Ideally, the cash value accumulates fast enough to pay back the bank. It's a form of leverage. And for a lot of folks, it can work out pretty well. For a lot of folks, it doesn't. And the last one, it's a little bit morbid to think about, but it's what's called a viatical settlement. Now, most advisors in my profession are not allowed to deal in viatical settlements, but it is an option out there for folks. It's essentially when you have a permanent life insurance policy. So I guess this would be fast forwarding. Let's say you already had a permanent life insurance policy and you have some sort of terminal illness of some kind, but you need money now. You don't have time to wait. You might choose to sell your life insurance plan to somebody else, some random third party, and they'll buy your life insurance from you and they'll pay you some money right now. But when you die, all your death benefit goes to them. So it's kind of creepy, a little bit morbid. Obviously, it's profitable for some folks, but it's not the most common thing I see out there nowadays. Luckily, insurance companies nowadays are implementing things where you're allowed to prematurely draw down on the life insurance in the event you do have a terminal illness of some kind. And that's usually defined as like the physicians are saying you're going to pass away in the next 24 months. You're allowed to prematurely draw down on the death benefit for things. And then when you die, whatever the delta is left over, that's what goes to your heirs. Okay, so as we wrap up, a couple of warnings to be aware of. I touched on this last time, but please know that for the most part, these policies are almost exclusively sold on a commission basis. And that does mean that as the policy premiums climb, the percent of compensation that goes to the insurance broker, if that doesn't change, they're expecting to get a pretty fat check in the event you buy one of these policies. Unfortunately, there is a huge conflict of interest, especially with folks whose sole compensation is through life insurance commissions. There's a huge conflict of interest in them recommending what's in your best interest. I'm not saying that's right or wrong. And as some inside baseball here, most insurance carriers will pay somebody about 90% of the first year premiums to implement one of these policies. So if you're implementing a permanent life insurance policy that costs you 12 grand, that insurance agent is getting paid roughly 11 grand in upfront commission. There are some insurance companies out there that are starting to market as commission-free permanent life insurance plans. However, they will allow the advisor to bill like a 1 or 2% assets under management fee on the cash value inside the plan. And that's okay. It also sets up a little bit of conflict of interest whereby the insurance agent wants your cash value to grow very quickly. They might be more apt to recommend insurance policies that have a more variable cash value component, and that might be a little bit too aggressive for where you want to be. Also, in addition, if the advisor isn't providing ongoing service, yet they're being paid to provide ongoing service, then you're wasting your money. So I'm not saying charging an assets under management fee on the cash value is good or bad. I'm just saying don't be overenthused if you read commission-free insurance policy thinking that it's a fee-free transaction. So what are your calls to action? If you currently have a permanent life insurance policy and you rack and stack it from what's available in the greater marketplace, you can always do what's called the 1035 exchange. And that's where you take your current policy and tax-free exchange it for another permanent life insurance policy or some other type of insurance contract. That may or may not be in your best interest, but it is an option if you find that the way that your current policy is designed does not rack and stack well against what policies are available nowadays. Although one more caution, I would say please don't go chasing the shiny next thing. I would stick to policies that have strong fundamentals that you understand. The best financial plan is always the one that you're going to stick with, so if you don't understand it, it's probably not going to be a good move. If you're a do-it-yourself advisor, if you're a do-it-yourself financial planner, or you work with a professional that maybe doesn't have a sophisticated process, I would encourage them and encourage yourself to review your insurance policies at least every 3 years. It's a good idea to make sure that you have a process in place to ensure you have enough insurance with where you're at in your stage of life. If you don't have any insurance, feel free to come back to this video when you start to look and shop around for insurance policies. Permanent life insurance is a viable option, and it's good to know the ins and outs and some of the features and benefits that exist out there. So I hope this was helpful. If you have any questions, drop them in the chat below or send me an email. We'll get you squared away. Have an awesome rest of the week. We'll chat with you later. Bye.